Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we are taking a look at three diverse tech stocks that investors might want to add to their portfolios or at least put on their watch list amid all the coronavirus uncertainty. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to also check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. Alrighty, so we're going to take a look at the beginning with a broader market overview to help try to make sense of what's going on, if we can at this point. But given that it's such an unprecedented situation, we're kind of all working at a day-to-day basis at the moment. So overall, the S&P 500 has fallen roughly 25% since mid-February. This was its fastest decline in history. And meanwhile, the volatility has been just as wild, as I'm sure many of you are aware. So the index has swung on average of about 5.2% each day in March. And this is on course to top the previous record of 3.9%. And this is all the way from back in November of 1929. And this is according to the Wall Street Journal. But with that said, the market saw its first 2-day and then 3-day rally of the month last week. In fact, the Dow even technically jumped into a new bull market on Thursday, just 3 days after reaching its bear market low. And then as of 11 a.m. Eastern Monday morning, the Dow was up over 2%. The S&P was up about 2.3%, and the NASDAQ was up about 2.7%. And this was as of 11 a.m. Eastern on Monday morning, and obviously things can change pretty quickly. So with that said, the volatility is likely to remain as the coronavirus continues to spread in the US. And then on Sunday, we had President Trump say that the White House was extending its social distancing guidelines through the end of April. And we're going to start to see the market and the economy truly tested over the next month. And this is going to see how impactful Congress's roughly $2 trillion stimulus package that was officially passed last week will. And so this is set to provide direct payments to many Americans, beef up unemployment insurance, provide loans to companies, extend additional resources to healthcare providers. And then along with that $2 trillion stimulus package, the Fed is going to purchase practically unlimited amounts of government debt to help provide liquidity and extend loans to businesses big and small. So all of that is going to try to help the broader economy amid this sort of halt, as much of a halt to the economic process in the US and the world as really many thought possible before this happened. But obviously the recent rally is pretty encouraging, and it might signal that the market's worst days are already behind us. But as we said, who really knows at this point, because there's really not much to look back and try to see what's happening based on anything that's happened previously, because this is pretty unprecedented at the moment. So the jump, obviously, though, does highlight that if you pull out of the market altogether, you often miss some of the best days, and this can impact your returns in the long run. So with that said, longer term investors don't really need to try to call a bottom. Instead, they should just look for stocks that appear to be solid investments, both now and for the somewhat near term and long term. So today we're going to take a look, as I said, with three tech stocks that are operating in very diverse pockets of that broader tech space. And we're going to start by taking a look at CrowdStrike, which trades under the ticker CRWD. So CrowdStrike was founded in 2011 and went public in 2019, about a year ago at this point. And its founders realized that the cloud computing was going to be the future of the broader tech space. And amid all of this, they tried to provide a cybersecurity offering that could be rolled out as quickly and easily as possible across their enterprise customers' digital footprints. So CrowdStrike focuses on a cloud-delivered endpoint protection to help detect and prevent breaches. We could go into a much deeper dive on what they're doing, but they're a cybersecurity firm that's built for the cloud, which is where most companies are now operating. And cybersecurity threats really aren't something that can be ignored even by the smallest companies, individuals, large enterprises. So one estimate from Cybersecurity Ventures, which is cited all over the place for cybercrime type figures, estimates that damages will jump from $3 trillion in 2015 all the way up to $6 trillion annually by 2021, which would be the equivalent of about 10% of the world's economy. So cybersecurity is going to be just as important as ever going forward. And it's also pretty immune to these broader spending cycles and something unprecedented like the current coronavirus outbreak, because people still need to spend money on cybersecurity. So with that said, CrowdStrike shares have soared over 75% since Monday, March 16th. This is up from about $33 a share to $58 a share as of Monday morning. And despite that big climb, they still rest over 40% below their 52-week and all-time highs. And if we look back, the company topped our Q4 earnings and revenue estimates on March 19th. And they also provided some upbeat guidance amid the current coronavirus economic downturn that has forced many to work remotely and forced many other companies to pull their guidance altogether because of all of the uncertainty. So we're going to take a quick look at what they did over the last year. So the company saw its total fiscal 2020 revenue climb 93%, with subscription sales up 99%. Its free cash flow came in at over 12 million, and this was against 2019's negative cash flow. And then the company also added 870 new net subscription customers in Q4 to end fiscal 2020 with over 5,400 customers. And this also, the company, this marked an expansion of 116% from a year ago. And they noted that their subscription customers who have adopted what they call 5 or more of their different cloud modules increased 33%. So they're getting clients to use more of their offerings. And their CEO, George Kurtz, noted on their earnings call that they're landing larger customers, more large customers that are starting with annual recurring revenue of over $1 million. And now if we look ahead, our Zacks estimates call for the company's fiscal 2021 revenue to surge another 52%. And this is above last year's over 90% growth. And this would see it hit about 730 million. And then if we look ahead to the next year, it's set to jump another 30% higher to about 940 million. And then the bottom line estimates are also very encouraging. So this year, fiscal 2021, its adjusted loss is expected to be cut in half, more than in half, from a loss of 42 cents per share to a loss of just 13 cents per share. And then if we look ahead to 2022, the company is expected to jump from a loss of 13 cents all the way to positive 15 cents per share in fiscal 2022. So cut more than in half this year, and then expected to jump all the way up to positive 15 cents per share in 2022. And then along with this, the company's earnings estimate revisions have continued to climb, and this helps it earn a Zacks rank number 2 buy at the moment. And then along with its positive guidance, we should note that the company provided what they're calling conservative guidance to help account for the coronavirus. Their CFO noted that they, quote, de-risked their guidance, but they noted that their pipeline was at record levels. So they could, if things turn around more quickly than many think, at this point, their outlook could be even stronger, but it's already very strong with the coronavirus taken into consideration. And in the end, CrowdStrike appears to be somewhat immune from the coronavirus sell-off, as if anyone is, because these big firms and small firms and everyone who's now being able to work remotely, this put even more burden on your cybersecurity worries. And CrowdStrike is a company that certainly stands to benefit from that. And they also stand to benefit over the longer haul as the cybersecurity industry grows along with our booming tech space in general. And it might not be the worst time to think about taking a somewhat small position in a tech stock of this size and growth that's trading still at about $55 per share. and it's traded all the way at just above $100 since going public. So CrowdStrike is certainly a stock worth considering. And then we're going to close with two stocks that don't really need as much background, and we're gonna go right into Verizon. As I mentioned, doesn't really need much of an introduction. Certainly not like CrowdStrike, which not maybe many average investor knew about before this. And so Verizon is a communication powerhouse that competes alongside AT&T for dominance in the U.S. wireless market, and along with its main rival, it's continued to focus on various cost-cutting measures. And this is as it ramps up its 5G push, because that requires a lot of capital spending. And then if we look back, the company closed last year on a high note. It recorded its most Q4 wireless adds in 6 years, and its earnings estimate revision activity has been somewhat mixed amid all of this uncertainty, which does help it hold a Zacks rank number 3 hold. But the stock also sports a B grade for growth in our style score system, and its earnings and sales are both projected to climb in fiscal 20 and 2021. So its bottom line is expected to grow about 2.7% this year, and then another 3.8% next year. And this would be on the back of 2% higher sales growth this year and about 1.5% higher growth next year. And then we should also note that Verizon is part of an industry that rests in the top 15% of our more than 250 Zacks industries. And the stock is down about 15% off of its 52-week high, so you could be buying Verizon at a little bit of a discount. And then along with that, one of the big pitches for investors at the moment is that VZ's dividend yield rests at about 4.6%. So this is an impressive premium to obviously the 10-year U.S. Treasury, which was at about 0.69% Monday morning. And it also blows away the S&P 500's average of about 2.23%. So that 4.6% yield is providing investors some much needed income amid all of this uncertainty. So Verizon is certainly a stock that looks to be a longer term buy and hold company that's not really going to go anywhere. It's a telecom giant that's ready to roll out its 5G, and its dividend yield is really impressive right now at the moment, and it's sitting about 15% below its 52-week highs. And then we're going to close with Microsoft, and obviously sometimes the obvious answer is the right one because Microsoft is about as blue chip as they come. So it might be a stock just that's can act as a safe haven at the moment. And if we look back, Microsoft did warn Wall Street in late February that setbacks in China would likely cause it to miss its personal computing sales guidance for the quarter. And this would have been considerably more of a gut punch before Microsoft's cloud computing business really began to boom. And the company also did note, luckily, that its Q3 fiscal 2020 guidance remained unchanged for all of its other units. And what, like I said, its cloud segment and its other businesses, but mostly cloud, have really driven growth over the last several years, and it now competes directly against Amazon's AWS for cloud supremacy. And despite its coronavirus warnings and the current economic downturn, Microsoft's longer-term earnings revisions have remained largely positive, which, like with CrowdStrike, helps it earn a Zacks rank number 2 buy at the moment. And then if we look ahead, the company's sales are expected to climb over 12% this year, and then another 11.4% next year. And then on the bottom line, it's expected to climb 18% and 12%. So this growth would mark the continuation of some really solid top and bottom line growth over the last several years. And they're both the top and bottom line estimates are very impressive for a company of its size and age. And Microsoft is also part of a highly ranked Zacks industry. Its dividend yield sits at about 1.28% at the moment, which tops another big $1 trillion tech rival, Apple. And Microsoft also consistently raises its dividend payout. And as I mentioned at top, with its cloud computing and its blue chip status and its ability to grow without a lot of reliance on consumer spending at the moment, investors might want to think about buying Microsoft. The stock's already jumped about 17% since March 16th, and it climbed over 5% on Monday. And despite all this positivity over the last several weeks, the stock still rests about 17% off its 52-week highs, and its valuation picture is pretty solid, especially where it's traded over the last 12 months. So Microsoft certainly, it's an obvious choice, but that does not mean it's the wrong choice at all. So we talked about three different tech stocks that are operating completely different businesses that investors might want to think about scooping up, or at least taking small positions in amid this coronavirus market chaos. But if you're not at least invested somewhat during the bad times, you might miss those quick bounce backs that we've had just in the last week or so. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.